Welcome back. You're watching The Firm. Now, what do Aviva, Barclays, EasyJet, HSBC, Xstrata, Cain and WPP have in common? All these companies have faced angry shareholders protesting against high CEO pay. Many in Britain are calling it a shareholder spring, and it's taken down some big-ticket CEOs. Spring fever has attacked more than a dozen British companies this year. And no ordinary spring this, but one in which shareholders have voted down the big salaries paid to top bosses at well-known companies. 32% of Barclays investors voted against the bank's pay report, especially since bonuses reportedly amounted to over £2 billion, whereas the dividend payout totaled $700 million. At Aviva, more than 50% shareholders refused to support the remuneration report, leading to the resignation of CEO Andrew Moss. Sly Bailey at Trinity Mirror also headed out the door when her remuneration came under attack. 20% at HSBC, 40% at Xstrata and 60% at Cain Energy voted against top management pay plans. And earlier this week, WPP boss Sir Martin Sorrell, the second highest paid CEO amongst FTSE 100 companies, was forced to defend his £13 million pay package after 60% of WPP shareholders refused to support the plan. Looks like last winter's Occupy protest has turned into a shareholder spring.
Yes, in a sense, what's happening is that some of the social disquiet that's erupted and that is manifested in the Occupy movement has spilled over into the shareholder arena. You know, the funny thing about the shareholder spring, as it's been called, is that shareholders have had the tools that they've been using for 9 years. And yet only a very small minority of investors were using them. This year, they've actually started to use them in large numbers. That's what's really interesting, and I do think that it reflects a generalized concern about what's happening.
What we're seeing at the moment is we're seeing very significant shareholder votes against these kind of pay packages. And the people who own shares are mostly big institutions or they're wealthy individuals, and the people who own shares on the whole, the poor people in the world, they're the wealthy people. And on the whole, the institutions that are voting against these pay packages are a part of the financial system, pretty big, rich investment firms. So I think it's much more linked to two things. One is the fact is that share executive pay has gone up a lot. It's gone up much more than there's any real justification for over the last decade or so. And the other thing is the stock market's been going nowhere.
To make his case, Matthew quotes IDS data showing that between the years 2000 to 2010, CEO salaries of the 350 largest listed companies rose by 108%, whereas their share value appreciated only 8%. Proxy advisory firm Manifest says last year, that is in 2011, the median increase in salaries was 10%, following a 13% rise in 2010. And get this, 1 out of 4 FTSE 100 CEOs received an over 40% pay hike last year. Now compare that to the 2-year stock performance, and it's clear why shareholders are so furious. That said, is linking remuneration to stock market performance fair or viable?
It's difficult in the short term, but we're not talking about the short term. What we're talking about is the long term. I agree the calculations are quite difficult, but almost anything would be better than what we have now.
It's absolutely correct that it wouldn't be reasonable to tie executive remuneration solely to share price performance, because as you rightly suggest, there are a number of factors that are outside the control of management that affect the performance of the share price. On the other hand, and so for that reason, we would take exception to, for example, executives being given outsized increases simply because, for example, the price of the underlying commodity that drives the share price of that company, let's say oil, has been galloping. So you really want to look at a variety of performance indicators.
If it's properly structured, I think it could work in a way that is acceptable both to shareholders and companies, but I think the important thing will be through the year seeing how companies are going to engage with their shareholders to find the middle ground that will be acceptable on both sides. The one thing that one does have to watch is this idea that there is too much going out from the companies to executives, and you have to balance that against the ability to attract the right people to run our companies in the UK.
The solution could include giving shareholders more say on pay. In India, shareholder votes on management salaries are binding, but then outside shareholders are a minority in promoter-run businesses. In Britain, where ownership is diversified, shareholders have only an advisory vote on remuneration. UK Business Secretary Vince Cable is considering giving shareholders a binding vote.
Binding vote is certainly a good idea. I mean, it'd be simple about it. The company is owned by the shareholders. They're the people that they are the legal owners of the business, and their vote, of course, their vote should be binding.
It's interesting. Vince Cable has indeed pushed for what has long been an advisory vote to become binding, and the reason for this is because he feels that a number of companies have ignored the verdict of shareholders. So when shareholders have increasingly of late voted in majority votes against the pay packages, companies have nevertheless not responded favorably. So for that reason, he wants to force them by making the vote binding. It's an understandable response. It's a response that I have some concerns about, because what you're doing is you're taking an action that investors have finally, after 9 years of a fair degree of inertia, to be fair, investors have had this tool for 9 years in the UK, and the majority of them have not bothered to use it. This year, you're seeing a number of majority votes against management, and it's finally doing what it's supposed to do. Now, the problem with turning that from an advisory vote, from, in other words, a serious red card in football language, to live ammunition, is that there is a serious risk that institutional shareholders who have finally got up their nerve to take a stand might suddenly retreat and say, for fear of plunging the company into turmoil, maybe we won't vote against. Maybe we'll just have a private conversation to signal our discontent. So in actual fact, we need to think carefully about the unintended consequences of a binding vote. An advisory vote is a very useful way of publicly expressing dissent, and then the company has to demonstrate that it is listening. If it is not listening, I think an intelligent way to address this is to say, if a company has lost an advisory vote, it should then be subject to a binding vote on the revised pay plan, and then it must secure shareholder approval. Because I think if we did that, companies would be very keen to avoid being forced to hold a binding vote.
In neighbouring France, shareholder spring is being driven by the government as shareholder. Newly appointed President François Hollande had made CEO pay a campaign issue, saying no executive at a state company should make more than 20 times the lowest paid worker's salary. And just this week, his finance minister proposed a €450,000 per annum cap on salaries at state-run companies to make state companies more ethical. Across the Atlantic, the weather has been spoiling, but the storm has yet to hit. In April, 55% of Citi shareholders rejected CEO Vikram Pandit's $15 million pay package. But a Davis Polk study shows only 2% of 639 companies failed say-on-pay votes, and 90% of the large companies won at least 70% approval from shareholders in say-on-pay votes.
When shareholders are voting against the remuneration report, some of it is an objection to how the company is performing. It's not only in absolute terms what an individual is earning, but how much profit the company is making, what's happened to its share price, what the dividend yield is. So one of the things that needs to be balanced out is that so that shareholders feel that the return is not going to executives but is actually being shared with the shareholders.
I think companies will increase their dividends. I think the own index, that's the only real practical step they can do. They can't do much about the state of the markets, which are affected, as you said earlier, by all kinds of things that are going on around the world, which no one can really control. But they can control their dividend. If you have higher dividends, share prices over the medium term will start to go up.
Giving markets and the economy a boost, concludes Matthew. May not be that linear, but there's no denying that this shareholder spring has given corporate leaders across the world hay fever. While talking of activism, here's an alert for next week when Sesa Goa and Sterlite hold court-convened shareholder meetings to approve the proposed merger between those two companies and their subsidiaries. Proxy advisory firm IIAS has recommended shareholders vote against the deal. To find out why, log on to thefirm.moneycontrol.com. With that, we wrap up this edition of The Firm. Thanks for watching. We'll see you next week. And just as we were closing the show, news came in that the jury has found Rajat Gupta guilty.
63-year-old Rajat Gupta found guilty of conspiracy and 3 counts of securities fraud involving tips to former Galleon chief Raj Rajaratnam about Goldman Sachs during the height of the financial crisis. Unlike some 5 dozen cases that have already come in this long-running insider trading case on Wall Street, this one did not hinge on wiretaps of the defendants. However, there were wiretaps where he was caught, in one case, talking to Raj Rajaratnam over an unrelated matter, the prosecution saying that established the fact that they had a relationship where they were discussed board matters of Goldman very casually. In one case, one prosecutor saying as though we were talking about last night's Yankees game. Those charges involve up to 25 years in prison for Mr. Rajaratnam. We have a statement from Pri Parara, the U.S. Attorney for the Southern District, saying Rajat Gupta once stood at the apex of the international community. Today, he stands convicted. He achieved remarkable success and stature. He threw it all away. In fact, the defense had said, why would a man in his 7th decade of life, with so much that he'd accomplished, so many connections, so much achievement, go ahead and tip off a hedge fund manager? The jury did not buy that argument, finding him guilty today.